Hey everyone, if you're trading and you're still seeing losses, even when following your strategy to the T, you're probably missing or unaware of this one key concept, the smart money technique or SMT divergence. In today's video, I'm going to break down what SMT divergence is, how to spot it, and how it can significantly improve your trading success. What is SMT divergence? SMT, or smart money technique, is a powerful tool that helps validate your trades by identifying a cracking correlation between highly correlated assets. For example, the Nasdaq makes a lower low while the S&P 500 makes a higher low. That's SMT divergence. It indicates a crack in the correlation where one asset is stronger or weaker than the other. But why is this important? It's important because it helps us identify when a certain asset is overly bullish or bearish in relation to its fellow counterparts, and potentially setting up a price to reach into a specific inefficiency in price, a liquidity pool, or return to equilibrium. How to use SMT divergence. Now let's look at how SMT divergence works in practice. Bullish SMT. If NQ makes a lower low and ES makes a higher low, as seen on the charts, this divergence signals a potential bullish move. This cracking correlation can validate a long position, providing you with an edge in predicting market movements. Bearish SMT. On the other hand, if NQ makes a lower high while ES makes a higher high, it indicates a potential bearish reversal, giving you a cue to go short. Remember, SMT divergence isn't an entry signal by itself. It's a tool to strengthen your market bias. Once you spot an SMT, drop to a lower time frame to find a more precise entry point. Here's a real-time example from one of my most recent trades that I took during the London session kill zone. When I first opened the charts, I had a bearish bias. One, due to a large sell-off that we had in the past few days, and two, because during the Asian session, we got very close to taking out the sell side liquidity resting below the previous month's low. Hence, if structure being built post midnight open leaned bearish, the previous monthly low was going to be my target for the session. So leading into this session, and just after the New York midnight open, I noted a clear SMT divergence with ES. And given that my bias was towards the Asian session lows and the previous month's low, I was confident that this marked the beginning of a downward move. After 2 AM, which marked the start of the London session kill zone, price spiked up into a 5-minute bearish order block, which was instantly respected. We moved lower and began respecting the first fair value gap created within the London session kill zone. Now, ICT often speaks about the silver bullet fair value gap that's created within the first hour between 3 AM and 4 AM New York time. However, through vigorous backtesting, I found that marking out the first fair value gap post 2 AM can also be used as confluence for your trading analysis, as observed in my chart here. You'll also notice that as price was wicking into this fair value gap, the bodies of these candles were also respecting this inefficiency in price, noted with these white trend lines. These were more indications that we were wanting to move lower. We began to near the 2:50 to 3:10 AM macro. Within this specific time frame is where I wanted to take my trade. As soon as 2:50 AM hit, price moved up into a clear 5-minute fair value gap, while at the same time wicking into and respecting this 1-minute bearish fair value gap. And on top of that, we also formed an internal SMT where NQ formed a higher high on the 1-minute time frame, where ES formed a lower high. You'll also notice that the same 5-minute fair value gap that hit on NQ does not get hit on ES. This is also another form of SMT to be noted. With all of these confluences in place, I immediately took a trade going short, targeting the monthly low. On my funded account on TopStepX, I took a similar entry, however I first waited for the 1-minute fair value gap to be inverse, taking my entry on the retest of this zone. From here, price sold off rapidly, just as we expected due to the heavily bearish narrative that we were outlining. I took my profit slightly above the monthly low, as I was anticipating the possibility of relatively equal lows being formed as this trade was taken prior to the non-farm payroll news release, which often comes with unpredictability surrounding its release. This trade totaled 60 points and secured me $1,205 with only one contract. As it's something that I briefly touched on in my trade example, I wanted to talk about the slight differences between what can be referred to as internal and external SMT. External SMT occurs at the extremes of a range, such as a range high or low, which can signal major reversals. For example, the initial SMT indicated on the chart is considered as an external SMT. It's at the high of a range that we expect to get hit after midnight open. So the fact that ES hits this respective high and NQ doesn't helps us build a narrative that price should begin moving lower, internal SMT. This occurs within a range at points like fair value gaps or order blocks. For instance, if NQ pulls into a fair value gap while ES does not, it signals potential bullish or bearish moves. So, start incorporating SMT divergence into your trading routine. It's a simple yet effective way to enhance your strategy's accuracy. By spotting these divergences, you will have a stronger bias and make more informed trading decisions. If you found this video helpful, make sure to like, subscribe, and hit the bell so you don't miss any future content. Thanks for watching and happy trading.